Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at the small company called Yext. Like always, I have my buddies Bull Solo and Darth Bear to help me keep track to see how this company is doing. Alright, so before we begin, let's just talk a little bit about the company. Yext is a very small cap company, so $1.7 billion company, so I think that's still considered small cap. Yext, in the past few days, in the past year, it has returned about negative 5% returns. In the past 3 months, negative 3.6%, and in the past month, it has given 7.2%. So let's talk about the company Yext. So Yext is a software company. They do extensions to a company's website. So let's say Taco Bell hires them. They create some form of extension that if people go to TacoBell.com, it allows the consumer to ask a very unique question, and Yext will give you the right answer for it. So like it says here, it provides the perfect answer straight from the source. And one of the things they mentioned that 82% of the answers in online come from unverified sources. So here they're trying to make sure that your business has the correct answers. And when someone searches for a question in Google, in any other search engine, that they provide, that they're giving the correct answer based on the brand itself. They also have different partnerships with like healthcare. If they have like they have certain medical groups where you go to their website and be like, I'm looking for a Spanish or English or a Spanish and English speaking doctor that deals with blah, blah, blah in my area. And it would actually give you the doctor's name and phone number. It won't just give you random links to random people that might fit. It would give you exact answers to your questions. So I think this is pretty good. And I think companies in the future, especially with voice coming along with Alexa, right? Alexa, and voice being a huge part of the future, in my opinion. People are going to be like Alexa, looking for the closest Spanish-speaking doctor in my area. And if Yext is implemented with a specific doctor, it would actually help provide that answer to Alexa and other voice controls or the website. So like I said, they actually have other products, but I think this is one of the most important things that they do. And like I said, I think it's very good for the company. So next, like I mentioned, right, Yext is a very small company, $1.7 billion in market cap, which is pretty low. The 52-week low is $12.83. The 52-week high is $23.32, and right now it's sitting at $14.71. So it's pretty close to its 52 low, a lot closer than it is compared to its 52 high. So let's get started, right? First thing we're going to take a look at is revenue. So here, revenue, I'm taking a look at quarterly data, and we can see every quarter this company has increased its sales every single quarter, which is good, right? This is a brand new company. It is a startup. You can see, when did it start? When did it go public? We can actually see here. It actually went public May of 2017. So this company is pretty new. So it's pretty impressive to see every year, every quarter, this company has been introducing higher revenue. So that's a great thing. Cost of revenue, unfortunately, is also going up. But we can see with gross profit is the difference between revenue and that cost of revenue. And gross profit is also going up. So that means that revenue is increasing at a faster rate compared to cost of revenue, numerically wise. So that's really good. So that for that reason, I'm going to have to give my first point to Bull Solo, right? Gross profit is pretty important here. The next thing we want to take a look at is net income. And unfortunately, this company has not provided any form of positive results. This company is burning money every quarter. This past quarter, this company had produced a net income of negative $42 million. That's definitely a big chunk. And for that reason, I'm gonna have to give a point to Darth Bear. So next, I wanted to see, right, why is revenue doing so good and gross profit so high? But at the same time, right, because look, revenue this quarter is sitting at $76 million. And gross profit is sitting at $56 million. That means this company has a very strong gross profit margins. But as a software company, that is expected, right? As a software company, gross margins are expected to be high because they don't really have an expense for creating that software, right? Every time they make one. So that's understandable. Usually software companies have a high gross profit margins. But now I want to take a look what's happening with their net income. So I ended up taking a look here at their 10Q report. And on their 10Q report, here we see that we're taking a look at 2019 and 2018. And this is 3 months prior to October 31st and 9 months prior to October 31st. So this is quarter 3 of this company's earnings. And we can see, right, sales right now, sales and marketing. And I was taking a look at this company's transcript for thing. And they say one of the most important things that they're doing right now is they have increased their sales and marketing team because they're trying to reach new customers. They're trying to reach new customers. Right now, this is a growing company, so they're trying to grab all these customers. So right now, their biggest hitters is sales and marketing. So that to me makes perfect sense. Right now, for quarter 3, sales and markets cost $62 million. Yeah, $62 million. And same time last year was $43 million. So just same time last year, it increased sales and marketing by about $20 million. Research and development did not go up much compared to the same time last year, so there's not much to talk about. But if we take a look at the 9 months ends, right, instead, so previously we took a look at 3 months, so this is the previous 9 months. This company has spent $160 million on sales and marketing. And same time last year, looking at the same time last year of 9 months, the company had spent $117 million, so almost $40 to $50 million less last year. So you can see that this company is definitely trying to improve its sales and marketing and reach reach more customers. Gross profit, like I said, for this quarter was $56 million. But sales and marketing this quarter costed them alone $62 million. So just because of sales and marketing, they were already in the negative. But as the more customers they increase, the more that this revenue is going to go up. And they did say that sales and marketing has become plateaued now. They're not expecting to increase many more positions in here. Another thing I wanted to take a look at here, just from the income statement, is I wanted to take a look at what type of growth we're seeing between revenue. And this is quarter 3 compared to quarter 3 last year. Revenue grew 30%. And quarter 2 compared to quarter 2 last year, revenue grew 31%. Quarter 1 this year compared to quarter 1 last year grew 34%. And every quarter compared to the same quarter last year seems to be growing over 30%. That is ridiculous. Those are good numbers to see revenue growth. And I want this to keep seeing. So next quarter, I'm hoping we still see like either high 29s or high 30 or low 30% revenue growth. So next, we're going to take a look at this company's balance sheet. This is the balance sheet is, if you guys have been watching me, this is my favorite document to take a look at. I feel like you can learn so much from a company's balance sheet. And the most important thing here is total assets is higher than total liabilities. Total assets is sitting at about $485 million. Total liabilities is sitting at $273 million. So that gives us a positive shareholder equity of over $200 million. Now let's take a look at how that how that asset distribution and liability distribution is broken down. So in the asset distribution, we can see a huge portion of this company's asset is cash and cash equivalent. This company has about $256 million in cash. And what I like about that is that's enough money to pay off the company's total liabilities, right? We saw the company's total liability was about 273. So this company, 256, can actually, all right, it's going to be 20 million short just in that. But if we count receivables and cash equivalents, which is every short-term assets, that's actually enough to cover the company's total liability from short-term debt to long-term debt. So that's always a plus, and that to me gives me that tells me this company is ready. It has a strong balance sheet. Next, let's take a look at this company's liability distribution. And we can see a big portion of this company's liability distribution is non-current debt. So non-current debt is debt that is due in over the next 12 months. So it can be anywhere from 12 months to 100 years. So it's over 12 months, and that's $110 million. And like I said, this company has enough cash and cash equivalents to pay that. So that, to me, I'm not worried about that. This company has payables of $45 million. This is how much it pays its vendors or whoever provides any form of service to them. But they receive about $38 million from receivables, which are kind of very, very similar, 38 to 45 million. It's not that big of a difference, so those cancel out. So again, that doesn't worry me at all. The next thing is about 40% of this company's liability is deferred revenue. And to me, deferred revenue is actually fake liabilities. This is revenue this company is gonna collect in the future. It's just it needs to provide. Most likely, this company is providing month-to-month basis, but they get paid on the yearly base. So this is just every month that they go on providing the service for the customer. This deferred revenue is gonna end up going in the assets, and it's gonna go into cash. So, like, to me, at this deferred revenue is fake liabilities. So for just this asset and liability distribution, I'm gonna have to give a point to Bull Solo, right? This company has a very strong asset with that $256 million of cash, and this company has very low liability distribution, especially since most of it is non-current debt. So next, we're going to take a look at the company's cash flow. The most important thing for me is cash flow from operations. I really could care less about cash flow from investing and cash flow from financing. I only want to know how this company is doing with its everyday operations. Unfortunately, we did see that this company had negative net income, and to that surprise, we're obviously going to have a negative net cash flow from operation. So if we take a look on annual data, the highest negative net cash flow from operations has been negative $32 million. So if this company has $256 million of cash with a negative $30 million of net cash flow from operation, in theory, this company should be able to withstand about 8 years. So that's if the company, right, in the next 8 years provides if this company provides no form of positive net cash flow from operation, and it maintains this negative $32 million, this company will still be able to survive for 8 years. That, to me, is a good thing, right? That is definitely a good thing. But in this past year of 2018, this company actually provided $5.2 million of net cash flow from operations. So let's take a look at how this company is doing this year. So remember, let's take a look at this is quarter 3. So quarter 3 did negative $31 million. Quarter 2 did negative $11 million. So that gives the company negative $42 million for this year. In quarter 1, it actually did about $1 million. So let's say we're sitting at negative $40 million in net cash flow from operations. In their earnings call, they did mention that quarter 4 will be a positive net cash flow from operations compared to the same time last year. So if last year they did $30 million positive, this company would only have a negative net cash flow of $10 million this year. So like I said, now with $10 million, this company can survive 20 years, 25 years without really worrying about its stuff. So that, to me, is good. But even though that's there, that negative net cash flow from operations is bad. So we're going to have to give another point to Darth Bear. But just like I said, that's why the balance sheet is such an important part for me. Because of that balance sheet, we're able to say, hey, screw that negative net cash flow from operations. It's minimal to the amount of cash this company has. So the final thing we're going to take a look at is this company's metrics. And I just want to take a look at some of the metrics. Price to earnings ratio is obviously low. The only ones I really want to take a look at here are current ratio and debt to equity ratio. Current ratio means current assets divided by current liabilities. Current assets need to be higher, so you want a ratio greater than 1. Right now, this company is sitting at a current ratio of almost 2.0. So for that reason, I'm giving a point to Bull Solo. And debt to equity ratio, this company has debt to equity is the company's total debt divided by the company's total shareholder equity. Here, you want shareholder equity to be higher, so you want a ratio less than 1. Right now, we're sitting at 1.28, which is not horrible. And it's pretty low compared to its normal values. So for that reason, I'm going to have to give another point to Bull Solo. Next, let's take a look at what the analysis have to say for this company. And like I said, I usually don't take a look at what they say, how they value the company, right? But these guys, they have all the technology, and they're really good at estimating revenue and estimating earnings per share. This is something that I personally won't be able to do in the time they're able to do it. And these values usually are pretty close to what the company is. So this is the only time I take a look at what other people have to say. I don't care if they have a buy or sell rating. To me, these numbers are the only thing I get from them. And we can see in the next 2 years, this company is still expected to provide negative earnings per share. So this company does not have a positive forward PE ratio, but we can see revenue they expect revenue to keep increasing, right? So for this year, they're expecting 297 million. For next year, they're expecting 380 million. And for a forward price to sales ratio, I don't know if you guys watch Shark Tank, right? But this is one that I actually get from Mr. Wonderful himself. Mr. Wonderful says that he would never pay 10 times the company's sales. And that's exactly what this forward price sales is. So these companies are way below that, 10 times below sales. And I think that's a nice rule to follow. So we can see this price to sales ratio keeps decreasing. So that's definitely great news. I definitely like the company. I like what they do. I really like the company's balance sheet. I'm not worried that this company will go under anytime soon. And they're increasing their sales. They have a great product. And they're not burning through that much cash. Even though they have a negative earnings per share, they're really not burning through that much cash that fast, which is pretty good. And if things work out, this company can actually be a pretty strong company. And for that reason, I do think I am going to open up a position on this company, and you will definitely see it in my next episode when I take a look in my next portfolio episode, which might be maybe not this Friday since I just did one Monday. It might be next Friday, to give it at least a 2 weeks time span of my portfolio. So take care, guys. I hope you guys enjoyed this episode. Let me know what you think about this company. This time, I did a different type of analysis. I was more into the actual numbers. And I actually had fun doing it this way. So let me know if you guys have any questions on why I looked at specific values. Feel free to ask any questions. I mean, I love answering any questions. And if you guys have a company, let me know. Take care. Have a good night, and see you guys.